Hello everyone, this is Kathy Lean with BK Forex's Turn Your Technical Indicators into Trading Strategies lesson. We are very excited about this specific class. It's one of my favorites because I really get the opportunity to share with you what some of our favorite techniques are to translate some of these strategies, technical indicators into trading opportunities. But before I begin, I'd like to share with you that this disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. So for those of you that are watching this video on demand, I highly encourage you to pause the screen, read through the disclaimer thoroughly before moving forward. So there's a lot of different technical indicators out there. But the classic way of using the technical indicators in the stock market, in the bond market, in the commodity market may not be the same way that you use them in the FX market. Granted, technical indicators are technical indicators, so their use is kind of universal. But I think it's important to realize that the Forex market is very unique in the sense that it can be very trending. And so we need specific filters in order to turn the traditional technical indicators into trading strategies. So that's what I would like to talk about today. So in order to have that conversation, I think it's important to realize that all markets have variety. There are different types of markets out there, and each of these markets, and in order to trade effectively, you need to thoroughly understand each of these markets. And so let me just make sure. So you need to thoroughly understand each of these markets and know which strategies to use for these markets. So as a trader, you need to be able to identify the four main market conditions. And this is the first step. This is the initial step to becoming a good trader. And it is also the first step to figuring out how to turn these technical indicators into trading strategies. So we want to start by saying that there are four types of markets. Range, sorry, I think my screen is kind of bugged out. Range, reversal, breakout, momentum, and trend. Each of these markets are different, and it's important to realize that that understanding each of these markets, can be different as well. So we'll start with range. I'm sorry, I don't know why my application keeps on bugging out. Let's just maximize this. So I want to make sure you're seeing my screen. So let's start by talking about range. Range is actually the most common trading environment for currencies. It's because price action, probably about 70% of the time happens in a range environment. And ranges can last for a very long period of time. Range is characterized by exhaustion or reversals near significant highs and lows. And so range, with ranges, what you're looking to do is you're looking to fade significant high or lows. Range is also characterized by a compression of moving averages. And the reason why this is important, the reason why we're starting with this is because I think it's essential to realize that you need to understand how to identify the market that we're in order to identify the technical indicators to use. So range can be characterized by exhaustion off of major highs and lows. They can also be characterized by compression of moving averages. And range can be characterized by ADX, which is the average directional index, of less than 40. That's basically what you want to look for when you're in a range-bound environment. One second. The key to trading range is the key to trading range is you want to fade highs and lows, add to your positions up to the range limits, use wider stops, and also focus on range trading on an intraday basis only. That's when we think we have the best opportunities for range trading. The greatest risk in range trading is, of course, a breakout. That's the greatest danger that we have in range trading. So, you could be happily trading a range, but the greatest risk for a range trading is that you could have a breakout. Ranges do happen the majority of the time, but sometimes, the greatest risk for a range is that you're trading your range and then suddenly it ends up breaking out. So we need to be able to decipher between a false break and a real break. And I would say that, a good measure of thumb is that if the instrument moves by more than half of the range, then, you've got a real breakout. The second type of market environment is a reversal. The reversal is different from a range in the sense that it's triggered off a price exhaustion or sentiment change. And with reversals, ranges, you're trading kind of intraday markets. With reversals, you're trading big swings. And so they're much more significant and you're keying off a major price point. Versus range, you're just keying off of, a tight consolidation. And, I know that to some people it may seem like it's similar, but they are different. Because if you take a look at this chart, reversals happen after a very big move lower, maybe a couple 100 pips or a very big move higher. And you're trying to pick a couple 100 pip move rather than a 50, 60 pip move. And usually when trends are large, they can last for a long period of time. Trend is the third type of market environment. Sorry. When we're trading trends, it's a very different type of market environment in that the price action only trends 30% of the time. And once it starts, it can continue way beyond reason. And while range trading and reversals are good for shorter term trading, I would say, trend trading is perfect for swing traders. Trend is characterized by higher lows in an uptrend and higher lows in uptrends and lower highs in a downtrend. So in order to identify a trend, you want to look for higher highs or higher lows. In a downtrend, you have lower highs and lower lows, and that's what kind of defines a quote-unquote trend-based market. Trend is also characterized by an expansion of moving averages. When you have moving averages kind of widening, that's when we're in a trend-based environment. And the wider the moving averages, the further away they are from each other, the stronger the general trend in the market. And of course, we can also use Bollinger Bands to help us define trend, because if the currency is trading between these four lines in this narrow area, let me just highlight it over here, that's a range-bound environment. If it's trading in the 1-2 band the upside, then it's in a trending environment. We use this information quite a bit for our entries and exits, which we'll get into in a little bit. The fourth type of market environment is breakouts. Breakouts, are very significant. Breakouts, are something that, that we all focus on quite a bit. And breakout is generally triggered off of event risk or the break of a key level. And breakouts can oftentimes turn into a trend. A breakout move can turn into, a bigger trend move in the markets. There are two types of breakouts. There is a breakout on news, and there's also a breakout on price. But regardless of whether it's a breakout that's driven by news or price, usually if the breakout is happening because it's a significant development. And because the development is so significant enough that it leads to a massive trend, new trend move in the market. And breakout works best off of key reference points like swing highs and swing lows, as well as daily, weekly, monthly highs. The greatest thing about breakouts is that they can lead to a massive move that will allow you to apply some of the trend-based strategies that I'll share with you in just a little bit. And what we really love about breakouts is that they can be clearly delineated on the charts, meaning that when there's a consolidation that breaks out, that breakout is very, very clear. And that breakout can have, quite a bit of continuation. And I think that breakout, can be quite interesting for all of us because when we do have a breakout, it may lead to a much stronger move in a currency. Now, the principles to breakout trading is basically that you want, first of all, the range highs and lows to be tested at least once. And then secondly, so basically in this chart, you want to see like we have a range high. So you're moving from a range to a breakout into a trend. So basically you see that your currency pair here has tested the top of this range at 131 3 times. And of course, we're looking for at least, once or twice of the test of at least 1 or 2 times. And the more times the test, the better. So you want to look for the range high or low to be tested, anywhere between 1 and 3 times. The more, the better. And then you want to make sure you filter for false breakouts because oftentimes you have a little bit of a probative move higher before a more meaningful breakout. And in that case, what you want to do is you want to basically look for a breakout to be greater than half of the value of the range. So in this case, you can see that Eurodollar breaks out, but the range has been 50 pips. You want to see at least a 25 pip breakout in order for it to be considered a quote-unquote real breakout. With breakout trades, you need to set a comfortable stop. And so what does a comfortable stop mean? A comfortable stop basically means a stop that's about half of the range. So if the range is 100 pips, you want your stop to be about 50 pips. So if you bought on the break of half of the range at 131.25, you would step your stop basically 50 pips below, 50, 75 pips below the range, or somewhere in between the range. I mean, the whole idea here is that if it breaks out and it goes back into the range, in worst case, if it breaks below the bottom of the range, then you're completely wrong on the trade. The key to breakout trading is that you want to try to let profits run because, with the breakout trade, there's a lot of false starts. And we try to filter out our false starts with this half a break of a range rule. But you need to try to let profits run because breakouts are rare and they fail often. But when they do get going, they can be quite significant. So there are two primary drivers of breakouts. One is news, and the second one is price. We already talked about this. But the longer the base before the breakout, generally speaking, the rule of thumb is that the stronger the potential breakout in the currency pair. So if we have like a 2.5-year range in the currency pair and it finally breaks out, this could lead to a very significant trends-based move in the currency. So the main takeaway is that in a range, you can scale buy low, sell high, buy low, sell high, but be careful of a breakout and define the breakout as a break of half of the range. And once the breakout occurs, a trend can develop, and that trend is generally defined by higher lows in an uptrend and lower highs in a downtrend. And eventually the move will exhaust. And when we look for price exhaustion, which I'll show you some techniques for doing so, it is still best and advisable to trade the reversal and the exhaustion in the direction of the trend. So in my opinion, if you're day trading, I think it's best to look for range or reversals, to trade range or reversals. If you are swing trading, I think it's best to look for trade breakouts or trend. So that's basically what you want to look for when you're trading. So that's basically what you want to look for depending upon the style that you are trading. Now, when it comes to trading, we talked about technical analysis, we talked about identifying the market environment, we talked a lot about fundamentals. I want to remind you that generally speaking, there are 3 ingredients in a perfect trade: fundamentals, technicals, and sentiments. And you want as many of these things on your side as possible. And that's really the way to isolate the best types of trades. So with that in mind, let's turn to technical analysis. Spent a lot of time talking about fundamental analysis. Let's spend a little time in previous classes. Let's spend a little time talking about technical analysis. With technical analysis, what we like to do is we like to show you how to turn the top technical indicators into trading strategies. But before doing so, I think it's important to establish that there are many patterns. The technical analysis is rooted in the idea of patterns. There's a lot of patterns in life. There's a lot of patterns on the charts. But it's important to realize that history does not repeat itself, may repeat itself, but does not repeat itself in the exact same way all of the time. Instead, there'll be different rhythms, there'll be different rhymes in the markets, there'll be different movements in the markets that end up leading to different types of behaviors. But generally speaking, technical analysis does work really well in Forex trading, just as it works in trading other markets. In terms of the top 10 indicators, these are the most popular and most commonly used indicators in Forex trading. Basically, hold on. These are the most common technical indicators in Forex trading: moving averages, relative strength index, stochastics, MACDs, and Bollinger Bands. We'll look at how to turn each one of these into a technical indicator, and then perhaps use some of these other indicators as supportive analysis. And this includes Fibonacci retracements, ADX, the average true range, pivots, and the parabolic SAR. So let's start with RSI. What is the standard way to trade RSI, the relative strength index? Well, to begin, I'd like to explain what the RSI is. The RSI is the relative strength index, and it's generally an overbought, oversold indicator if you're not familiar with it. And with RSI, what people typically look at is that if RSI moves above this black line, which is usually about 70 and 30 are the parameters, if it moves above 70, it's considered overbought. If it moves below 30, it's considered oversold. So let me see if my spotlight will work here. Looks like the spotlight isn't working. I'll use the arrow instead. Okay, so the arrow now is working. So the classic way of using the RSI is what people would do is they would basically buy when the RSI goes below 30 and sell when the RSI goes above 70. But the problem if you do that is that, the currencies trend a lot. And if you did that over here, RSI remains above 70 for a long period of time. You had to wait quite a bit of a trade. And even here, RSI remained below 30. If you tried to pick a bottom, you would have bought here, bought here, bought here, bought here, bought here, and it went significantly against you before the trade became profitable. So it is definitely trickier. And definitely using the RSI the classic way that's taught to you, in my opinion, is not the most fruitful. So how do we turn RSI into a trading strategy? Well, first of all, we still use the parameters 30 for the bottom and 70 for overbought. But what you want to do is you want to put on some filters. You want it to show you that there is strength before you want to show you that there's strength before you actually get into the trade. And the way you want to do that is you want to look for RSI to drop below 30. Then you want to look for it to rise back above 50. And when it drops below 30 and then rises back above 50, that's when you want to consider buying. So here's an example. What you want to do is you want to look for the RSI to, let me get my arrow. You want to look for the RSI in this case to drop below 30, which is what it did right here. And then you want to wait for the RSI, and you don't buy yet, because if you did that, you would have bought here, 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 and here. So you wait for RSI to drop below 30. Then you wait for it to touch 50, which is right around here, and that's when you buy. So you buy at 2080 instead, and your stop, get rid of this arrow here, your stop is at the swing low, and you want to close half of it when it moves by 1.5 to 2 times risk, and then you want to trail your stop on the remainder of the position. So here's an example. This is an example on the S&P, but you can use this, we use this in currencies all the time. But it just shows you that it's kind of a universal strategy. So here we're going to wait for the RSI to drop below 30 and then move back above 50. So we enter right here. Your stop is at the swing low. The swing low is defined by the clearest, obvious near-term low, which is right here. So you go long here, swing low, stop, and then you exit half by the amount risk, and then you trail your stop. You probably want to exit when it moves into overbought territory. Let's take a look at another example. So this is an example where same story. Let me get my arrow going. You want to basically look for the RSI to drop below 30 down here. Then you want to wait for it to cross above 50. That's when you go long. Your stop would be right here at the swing low. And then you wait. You wait to close half of your position, probably somewhere around here, and then the second half when it goes into overbought territory. There's actually an example on the short side here where we went above 70. Then you waited for it to touch 50. So you were basically sold right around here. Stop over here, probably get close to half your position here, and the rest when it moves into oversold over here. But to outline the short trade rules, they're the following. You want to look for RSI to be greater than 70. Then you want to look for it to move back below 50. Once it's moved back below 50, that's when you want to look to sell. Your stop in this case is at the swing high. You close half of the position when it moves by 1.5 to 2 times risk. In spot forex, I think you should do 1 times risk. If you're trading any other instruments, you can probably be a little bit more fluid, and then trail your stop in the remainder of the position. Trailing stop is a little bit more, there's more freedom in trailing stops. You can trail by 1%. You can trail by a specific amount of pips. You can trail by something, moving average. At the time, you're in profit, so you can trail by pretty much whatever you want. So in this case, we saw that RSI rose above 70. We waited for it to drop below 50. We're shorted here, 21.13. The S&P stop at 21.21. This works just as well as currencies, but I just wanted to illustrate to you. I just had this example in equities, but it works just as well in currencies. And then you exit half somewhere here and trail your stop on the remainder of the position. So that's how you would turn RSI into a trading strategy. Let's take a look at another example. You can use this on intraday charts too. This is another example here where RSI drops below 30, you wait for it to cross above 50, and you exit somewhere around there. And then this is another example where you wait for RSI drop below 50, you wait for it drop below 30, you wait for it cross above 50, enter here, and hopefully get a little bit more juice out of the trade. So that's how you turn RSI, which is a common technical indicator, into a trading strategy. And, like I said, we like to do this in equities, and we also like to use this in currencies as well. But my personal favorite technical indicator, and the one that I feel provides the best type of opportunity is the double Bollinger Bands. And I really like the double Bollinger Bands because I feel like they provide us with so much information, so much useful trading techniques. And, just generally speaking, is extremely, extremely valuable. For some reason, this is not my full slide deck. So what are the double Bollinger Bands? The double Bollinger Bands are basically the 20-period 2 standard deviation Bollinger Bands and the 20-period 1 standard deviation Bollinger Bands. And actually, it was the battle-tested swing trading strategies that I really put a lot of meat into. I was just trying to check my slide deck. Okay, so what are the double Bollinger Bands? Well, the double Bollinger Bands are my personal favorite trading strategy. And the way that I use the double Bollinger Bands is I put 2 sets of Bollinger Bands in my charts. The 20-period 2 standard deviation Bollinger Band, the 20-period 1 standard deviation Bollinger Band. Now, typically Bollinger Bands are also considered overbought, oversold measures. And the whole idea with the Bollinger Bands is that if it goes if it touches the 1 standard deviation Bollinger Band on top, it's considered overbought. If it touches the 1 standard deviation Bollinger Band on the bottom, it's considered oversold. But as you've seen in some of the charts I've showed you with currencies, overbought, oversold is extremely elusive in the sense that they don't always work very well. I mean, if you take a look at this chart here, even if you take a look at the dollar yen, you can see that when the trend is strong, the currency pair can remain in the 1-2 band for days, weeks, and sometimes even months at a time. You can take a look at, let me share with you my live chart. Sorry, let me just pull up my live chart with my Bollinger Bands. And you will see, let me just hope that this updates itself, that, in this move in dollar yen, it remains confined in the 1-2 band for a very long period of time and can remain confined in the Bollinger Band for a very long period of time before actually coming out of it. So if you were simply to use Bollinger Bands the classic way, what you would have done, you would have sold here, sold here, sold here, sold here, sold here, and basically faced hundreds of pips of losses. That's why we overlaid the double Bollinger Band. And in the lesson on battle-tested swing trading strategies, I'll go over how to use the double Bollinger Bands to pick tops and bottoms. But just kind of generally speaking, the whole idea is that you want to wait for the currency pair to close, to finally exhaust itself, close below the first standard deviation Bollinger Band. In this case, it would be below 112, right around here, and that's when you want to pick the top because you want it to show you exhaustion first before you quote-unquote pick the top in the move. And that's really what you want to focus on. Now, as a rule of thumb, if the currency pair is trading in the 1-2 band on the upside, it is in an uptrend. If it's trading in the 1-2 band on the downside, like, let me move over here. Like over here, it's in a downtrend. Let me get rid of the quote box. It's trading the 1-2 band over here, it's a downtrend. If it's trading between the 1-2, the inner lines, the first standard deviation Bollinger Bands, then it's in the quote-unquote range trading zone. And so you want to, trade the range when it's trading between the first standard deviation Bollinger Bands. You can pick tops and bottoms once it's exhausted and come dropped below the first standard deviation Bollinger Band here. There's so many different ways to trade the double Bollinger Bands, and that includes, using double Bollinger Bands to pick tops and bottoms, using the double Bollinger Bands to join new trends, and using the double Bollinger Bands to join existing trends at value. These are all different techniques that we will be sharing with you in our battle-tested swing trading strategy lesson. But I do want to get back to the 10 technical indicators and how to use them. And I want to review them on the charts. Let me see if I can find the top 10 technical indicators. So we talked about RSI and we talked about Bollinger Bands. These two have very specific trading strategies that I personally like a lot. But how would you use moving averages? Okay, one thing that's very simple is moving averages. We'll just pop on maybe a 20-period moving average. Moving averages also give you a gauge of where the trend is. And there's many different ways to use moving averages. One way to use moving averages would be to wait for the currency pair to break the moving average and then to go in that direction of the trend. Another way, classic way of using moving averages, is to wait for it to touch the moving average. Like in this case here, sell right here with a stop above the moving average. There's so many different ways to use the moving average, but in order to turn it into a trading strategy, what we like to do is maybe, overlay on a different moving average, like the 50-day SMA. So let's say we lay on the 50-day SMA, and one way to turn the moving average into a trading strategy is basically, you can wait for the currency pair to retrace. Like let's say in this case here, we're rising. You want to wait for the currency pair to retrace to the 20-period moving average, set the stop below the 50-period moving average, hoping that the trend will reverse trend will reverse at either the 20-period moving average or the 50-period moving average, and then join it there. So this would be an entry if you waited for the retrace. Here, these would be entries. This would be an SA where in a downtrend. You can wait for it to retrace here. This would be an entry. Sometimes eventually, you'll get stopped out because it doesn't work 100% of the time. But that could be one way to turn the moving averages into a trading strategy. The next technical indicator is stochastics. So taking a look at stochastics are very similar to RSI, where they measure overbought, oversold. And the whole rule of thumb is that if the currency pair, so I'm just looking at my charts, if the currency pair goes into overbought territory, sell. So if RSI rises above 80, sell. But take a look at what's happening here in this chart. RSI can be above 80 for an entire month, and if you sold, you would just face continuous losses. So instead, what you could do is do something very similar to the RSI, where you basically wait for it to go above 80, wait for it to drop, maybe below 60, the RSI, and then sell. So you wait for RSI to show you weakness before arbitrarily picking weakness in in dollar yen, for example. And in a downtrend, you're watching it sell off, sell off, sell off. What you want to do is you probably want to wait for it to close above 60 or 50 or 60, depending on how aggressive you want to be, and then buy for a stronger move higher. MACD. How do we turn MACD into a trading strategy? MACD also a measure of momentum, strength of trends. And let's just look at a different currency pair for variety purposes. Generally speaking, the rule of thumb using MACD is that if you have a moving average cross, if a MACD cross, like these crosses, take the trade. So if the blue line crosses below the red line, the blue line is the quote-unquote faster line, then sell. If the blue line crosses above the red line, buy. And I actually think that's quite effective, but what you could do is you could maybe, and actually, it's one of those technical indicators that I like quite a bit, and I would say that, you could potentially just, take that trade as, take this indicator as is. But if you want to turn it into a trading strategy, what you could do is you could we could look at the shorter term charts, the 5-minute charts, and we can overlay a 20-period SMA. We could overlay a 20-period SMA here, and basically this is a strategy called the Momo trade. What you can do is you can wait for the currency pair to cross above the 20-period SMA, and if at the time the MACD is also going from positive to negative, then you can potentially take that trade, and and basically buy it in the direction of the moving average cross. So to be a little bit more specific, what I mean by that is in this example here, what you could do is let's say euro dollar crosses below the first standard deviation, the moving average here. And at the time you can see that MACD's turned negative, then you can sell. So in this case, maybe you'll sell 113.20, but you have to go for a very small profit. Generally speaking, the MACD turn is best used in the direction of the trend. So right now, clearly the direction of the trend in euro is lower. So if you see that we've got a moving average cross downside here, you wait for the MACD to turn, you sell here, stop above the 20-period moving average, and then you can see it's a very strong move lower. Dollar yen, if you look at the daily chart, multiple time frames, very helpful. Here is in the uptrend. So you want to look for your MACD cross in an uptrend. So here, your MACD, this one we're still in a negative side, so it's not a trade. But here it crosses above your MACD, and you can see that it moves higher. It's very, kind of esoteric, but it is, it is a separate way. It is, a way to use the MACD. But as I said, I think it works pretty well on the daily chart, just trading the moving average cross. We already went over the Bollinger Bands. So if you look back at our slides, we said we were going to look at how moving averages work, relative strength index work, stochastics, MACDs, and Bollinger Bands. Fib retracements are just good to use to measure where a currency pair or an instrument can stop. Let's look at something that's not at multi-month highs or lows. But let's, I'll just drop on some lines here. So here, fibs can use as, if it breaks above a fib, for example, you can see that this pullback in dollar CAD stopped right at the Fibonacci support. Right now we're breaking above the Fibonacci support on this chart, and that suggests that we can see a much stronger move higher. I like to use monthly Fibonaccis for key levels, especially when we're trading, when currencies are at multi-highs and lows. It's something that I like to use quite a bit. And I think that it can really give us a frame of reference. So like in dollar yen, if we used Fibonacci's are drawn from significant highs and lows. So here, Fibonacci is drawn from significant high and low. So people are wondering, dollar yen's rallying, where could it stop? you can pop on your fib and you can see that this move actually stopped to the pip at the 23.6% fib. So they're very effective in identifying significant support and resistance levels, and I like to use that quite a bit. ADX measures strength of trends. Generally speaking, I would say that if ADX, and we don't need all these blue and red lines, we just use the main ADX indicator. If ADX is greater than 25, the trend is strong. If it's less than 25, the trend is weak. I don't use it all that often, although I do use it as a potential indicator for one of my other trading strategies, or a potential trigger for one of my other trading strategies that I'll share with you in our battle-tested swing trading strategies class. ATR measures average true range. So if you want to figure out, I don't really think it's too useful, but if you want to figure out, for example, where can I potentially put my stop, this gives you the average true range of the average range of the currency pair, and that could be a reference point on, where to put your stop in on a move. So this says 140 pips is the range, the average true range. So maybe if you're trading a daily chart, you want to put your stop, use 140 pips as a reference for your stop. Pivots, I have to turn to different charting package for pivots and parabolic SAR, but pivots are also used as reference points to fade a move. So I like pivots quite a bit as a reference point to potentially fade a move. My charting package doesn't have pivots, but I'm going to pull it up here. And let me see if I can get it going here. So just pulling up a chart, and then I'm going to add on pivots just to show you how pivots are used. So basically it's a daily chart. Let me add on pivots. Pivots, points, highs, and lows. And, they're just basically levels that you could buy or sell a currency pair at. Pivots I kind of feel like, are only good in retrospect, but, you could use them on 4-hour charts. I don't like to use them too much, but for example, if I was trading this chart, 106.85 is a pivot, so if it breaks above 106.85, then we're headed much higher. So you can use it as a breakout point, or you can use it as a stop point for your trade. Parabolic SAR is the last indicator. So with parabolic SAR, they're basically these dots, also, pretty useful as, in my opinion, as stop reference points. So if you're selling the euro, for example, you put your stop pretty much, where the parabolic SAR is. I don't think there's any other way to use these indicators aside from the way they're generally taught, but that's basically what we're looking at in terms of how to use any of these technical indicators. So hopefully I was able to share with you, explain to you how each of these technical indicators are used, share with you a couple of different techniques for trading these technical indicators, and then also shared with you how to turn the RSI and the Bollinger Bands into trading strategies. We're going to talk a lot more trading strategies in our battle-tested day trading and swing trading strategies course, so definitely look out for that. So we're very excited about that, and that'll be one of the lessons that follows. And in that course, I'll also share with you how to use Bollinger Bands to determine trend or range, how to use Bollinger Bands to pick tops and bottoms, joining new trends, as well as joining existing trends at value. So with that, I'd like to open the floor up to any questions you may have about anything that we talked about today. And we covered a lot. Do you consider Elliott wave count or not? Very good question. Elliott wave can be very effective, but honestly, I don't really use it on a day-to-day basis, and I'm not really familiar with I'm not very familiar with how to use it. You really need to be an Elliott wave expert. I've seen many traders trade Elliott wave successfully. It's not something that I use, but it doesn't mean that it doesn't work. Any other questions or charts that you may want to look at? Ichimoku is primarily used by the Japanese, and the clouds are kind of interesting, and they're basically used same as support and resistance. For moving averages, what do I use? I love the 20. I love the 50. I don't use the 8 or the 240. I use 20, 50, 100, and 200. And then battle tested trading strategies, I'll talk about that there. And I generally use the SMAs for daily charts and 4-hour charts. EMAs I use rarely, so primarily SMAs. So when we're talking about the moving average cross, what we were talking about is the MACD, I believe. Let me share with you my chart again. So we're talking about the MACD, and basically with MACD, if you don't have a strong trend, typically speaking, the way people use MACD is when the blue and the red line cross, like the blue drops below the red line, that would be an indicator sell. If in this case we finally get across to the upward, that would be an indicator to buy. Any other questions or charts that you may want to look at? If not, like I said, if you're watching this video on demand, you can always email us questions at Kathy@bkforex.com.